Hi, everyone. Welcome back to the Always Bookkeeping YouTube channel. Today, we're tackling one of the biggest financial planning debates in Canada. My name is Alena, and I'm joined today by one of the owners of Always Bookkeeping, Tony. So, Tony, we're tackling our RRSPs versus TFSAs today.
Yeah.
I'm really excited because everyone seems to think that RRSPs are exactly what you should be doing.
Yeah, but today we're going to talk about the benefit between TFSA and RRSP and which one is more beneficial for you as a Canadian.
Excellent. I'm really excited. So TFSAs or RRSPs, which one is better for retirement? For years, the RRSP was treated as the default savings vehicle, but today many planners are increasingly prioritizing TFSA because of how powerful it can be for long-term wealth and retirement flexibility. That said, RRSPs are still extremely valuable in the right situations, especially if you're a T4 employee with an employer who has a matching program. So let's break it all down. Tony, at a high level, why are more experts leaning towards the TFSA as the foundation for retirement programs?
So TFSA, tax-free saving account in Canada, me and you and everyone in Canada has, is a truly tax-free saving account. What does that mean? Not just today, but forever. With an RRSP, it's just what I think about RRSP is more of a tax deferral program more than a tax saving program. What does that mean? So every dollar that you put in RRSP today, you can get like a tax refund, lowering your income for this calendar year. But with TFSA, there's no reduction upfront, but when you withdraw it in your retirement, the money that you're taking out of your TFSA is not taxed. So over a decade or more with investing, growth, and dividend reinvesting is very powerful when the money is compounding. That's great.
Mm-hmm. All right. So when people say TFSA is more powerful, what do they mean?
So there are three components to this. So what TFSA does is that the first one is tax-free compounding. So whatever you have in your TFSA account, whether that be stock, gold, or Bitcoin, all gains, all growth, and dividends reinvesting are tax-free. The second component would be withdrawal. Don't count as income compared to RRSP. So that means no higher tax brackets, no benefits reduction from the government, no OAS clawbacks later. And the third one would be no forced withdrawals. With RRSP, you have to convert your RRSPs to RRIFs when you turn 71. TFSA doesn't have that requirement. And that control in your retirement is incredibly beneficial for you.
Excellent. I didn't really know that. I think I just heard RRSPs and then you just have RRSPs forever, but they convert into RIFs and then you pay taxes on them.
Yeah. So RRSP is your saving and tax deferral plan, and RRIFs is when you have to wind down your investment into what people call it withdrawal phase. So when you turn 71, the government wants you to start withdrawing it, and they force you to convert it from RRSPs to RRIFs. And every year, it has a minimum withdrawal rate. So I don't remember on top of my head, but when you turn 71, I think it's around 4 or 5% withdrawal rate from your RRIFs, and then it goes up as you grow a little bit older.
All right. Excellent. So Tony, RRSPs still play a big role, correct?
Yeah. So RRSP is very powerful if you are a T4 employee and your employer has a matching program. What does that mean? So if you have a T4 job and your salary is $100,000 a year, usually employer have a matching program between 3 to 5%. Let's use 5% as an example here. So 5% of $100,000 is $5,000. If you contribute $5,000 into your RRSP, throughout the calendar year, the employer would match it $1 for $1 up to that amount. So it's very powerful in a way where you get instant return on your investment. So for every dollar you invest into the RRSP, you get a dollar back from your employer. That's 100% on your ROI. So that's very powerful, and it's guaranteed wealth building. In that scenario, contributing enough to capture the full match from your employer is what we would recommend for a T4 employee.
So an employer matching program really changes the equation, doesn't it?
It does. So it's really smart when you take advantage of that program. So in that order, if you are a T4 employee and you have an employer matching program, we would usually recommend contribute to your RRSP up to the maximum allowance from your employer. The second would be maxing your TFSA. So everybody in Canada gets a $7,000 per year for your TFSA. So max out your RRSP with your employer, max out your TFSA, and any additional RRSP. We usually don't recommend this, but for a really high income individual T4 employee, we recommend it so that we can defer some taxes for you in that calendar year. But usually that's not the case. We would rather you max out your TFSA contribution room. Just because you have 7 this year, when you turn 18, you get that room. If you don't max it out, then you can carry it forward. So usually if you around 30s or 40s individual, you can just contribute more than $7,000 for that year and just max it out that way instead of more into your RRSP.
All right. So outside of the employer matching, why does TFSA often win for retirement planning?
So let's do a comparison, okay? So RRSP withdrawals are taxable, increase your reported income, can reduce benefits from the government, and can trigger OAS clawbacks.
Wow.
TFSA, tax-free. When you withdraw from your TFSA account, don't affect your government benefits, don't affect tax brackets because, again, it's tax-free. So it doesn't bring you into certain tax brackets or, higher tax bracket if you take out more than you compared to when you do it in RRSP, and don't show us income on your personal tax return. That gives retirees far more control with a TFSA. So that's the benefits that I would recommend all of our clients at Always Bookkeeping, that, TFSA is the better plan for you.
That's incredible to me that it's money that you've saved, you've put away, and then when you take it out, not only are you taxed, but the government counts it as income. This is money you've already earned.
That's right. So like I said, it's like a tax defer program more than a tax saving. A lot of people mistakenly understand it a way where you save money on your tax because you contribute to it this year in 2026 and you get a tax refund because you contribute $5,000, $10,000 into RRSP. But when you take it out, you get tax on it. So it's not really a saving account. It's more of you borrowing against your future income when you contribute to your RRSP. So that's another way of looking at it.
That makes more sense. Calling it a tax deferral plan makes a whole lot more sense than just like, oh, this is how I'm saving money.
Exactly.
So Tony, let's talk some real world retirement scenarios.
Okay. So let's talk about 2 people here. So let's call the first guy Christopher, and he's an RRSP focused individual, and he withdraws $70,000 per year from his RRSP, pays income tax on that. I think that would be the 3rd tax bracket on the personal tax marginal rate, and possibly lose benefits just because $70,000 is pretty high for a retiree. And then I get Alan, second individual that's TFSA focused, saver, and withdraw $70,000 per year. And that whole $70,000 per year is tax free. You don't pay income tax on that amount, and keeps full government benefits. So your OAS is not clawback. Your other benefits from the government are not affected at all. Same lifestyle, very different financial outcomes. So the whole $70,000 Alan takes out, he enjoys the full amount. Christopher takes out $70,000 from his RRSP, pay a big chunk of portion of that into personal tax, and risk losing government benefits and OAS. So that's a 2 scenario that we usually see from our clients and from retirees when they start taking out the monies from their saving accounts.
Wow, that's a huge difference just based on 2 very similar people.
Exactly. Thousands of dollars on taxes owing.
Wow. What about long-term compounding? Does TFSA outperform RRSP?
So at Always Bookkeeping, we always almost recommend TFSA planning for our clients for their retirement. That usually most cases are usually very powerful for T4 individuals as well as business owners and entrepreneurs. So when you contribute your TFSA, the taxes are never applied. Withdrawals don't create personal income tax, and future tax rate don't really matter, and policy change don't matter as well. What does that mean? So if they create increase or decrease your personal marginal tax rate, that doesn't apply to your tax-free saving account. And when you invest within your TFSA, whether that be gold, Bitcoin, or dividend-paying stock, and you reinvest your dividend year after year, and you do that within the next 30 or 40 years, that's really powerful, just because all the gains, all the growth are not taxed at all compared to an RRSP or any other investment account that you have.
All right. Wow. Who should prioritize TFSAs?
Everyone. So if you're Canadian, everyone should prioritize TFSA. We strongly recommend you maxing it out every year if you can. If not, if you just want to dip your toes into, saving money and, you're a little bit younger, $50 a month, $100 a month, just to get you into that habit of having it, what we call like a non-negotiable payment from your checking account. So just set it up in a month where whatever you can afford. Like I said, $50, $100 just to get you comfortable, used to having that money contributed to TFSA, and try to max it out every year. And if you're a really high individual income earner, then just do more than 7. You probably never max it out when you turn 18 in Canada. So you probably have like a pretty good chunk in your room. So just trying to max it out and work toward that maxing out that room that you have with your TFSA.
All right, so the max out amount is $7,000, but that's for every year since you turned 18?
Exactly. So if you turn 18 in Canada, you automatically qualify for that $7,000 contribution room for your TFSA. And it's powerful because if you don't max it out this year, it can carry forward next year.
Wow.
For example, you only do $4,000 this year. Next year, you'll get it, the 3 that you didn't use the year prior. So this year you can do 10 instead of 7.
Wow.
So it works for someone that is young, starting out, and earn more and more down their career path. And so instead of spending the difference when you make more money, just contribute to your TFSA, just because you can carry forward from the years that you never max it out.
Wow, that's a lot of savings.
Exactly.
So you mentioned that everyone should prioritize TFSAs, but who should prioritize RRSPs more heavily?
So anyone that has a regular T4 job. So like I said, if your employer has a matching program, for sure, take advantage of that. It's just because your ROI is basically 100%. So every dollar you contribute to your RRSP, you get $1 back from your employer up to that annual maximum amount. So whether that be 3 or 5% from your salary. High income earners that want to defer some tax for the later years should contribute some into your RRSP so that you don't pay as much tax on your personal tax, because it lower your income tax. But then again, if you do have TFSA room, do that before you do your RRSP. That would be my advice for anyone that hold a T4 job.
That sounds great. Let's address the traditional advice: always max your RRSP first. Is that true?
Not anymore. That was before, but the plan now should be, what we recommend all of our clients would be emergency fund, whether it will be 3 months of emergency fund. So you can cover your rent, all your expenses for 3 months in your high interest saving account with your bank. Usually that's okay. And then RRSP employer match program, if you do have that. So do that, and then TFSA. Max out your TFSA $7,000 a year. If you can do more, great. If not, 7 is usually what you should aim for. And then additional RRSP contribution if the tax brackets justify it. Usually we don't recommend that until your TFSA is maxed out. And then this approach usually really good for balancing tax saving, flexibility and retirement planning. So that the TFSA is really good for wealth preserving for everyone in Canada.
Great. So if everyone's heard that you should max out your RRSP first, rules have changed.
Yes, TFSA over RRSP, in my honest opinion.
As the expert. So what's the biggest mistake that Canadians make?
So the most common mistake that I usually see is when Canadians prioritize RRSP without considering any other alternative, which is our TFSA. So they just don't consider future income, retirement taxes, flexibility that they would need in their retirement years, employer matching program, long-term strategy, and then the most important one is preserving their wealth. So that's usually what they don't look into when they just head first into an RRSP saving account rather than any other alternative.
Okay, good. If someone wants to build maximum retirement security, what role should the TFSA play?
So for many people, TFSA should be a foundation of retirement wealth. It provides you tax-free income later when you withdraw it. Protection from tax increases. So if the government one day decide that your personal tax marginal rate goes up, then it is protected when you take out the money from your saving account. No forced withdrawals. Like I said, you are not forced to convert your RRSP to RIFs. So that's another benefit from TFSA. Full control over retirement cash flow over RRSP. So because it is tax-free, you can take out as much as you can compared to RRSP, just because you don't want to pay as much tax when you do it on the RRSP side, just because the more you take out, the more you are taxed.
So Tony, I've got one last question for you. If someone can only afford to do one thing this year, what's the one thing they should do?
So if you do have an employer RRSP matching program, definitely take advantage of that. But if you can after that, then for sure prioritize building your TFSA and max it out every year or more, just because you may have additional contribution room in your TFSA. That create tax-free capital now, and then your future would, thank you for, creating and preserving the wealth, just because you won't be taxed on the gains on the withdrawals later in your retirement. And here's the bottom line. RRSP is powerful, especially with employer matching and high income tax planning for individuals, but TFSA is often stronger in long-term wealth building and preserving your wealth, and then transfer it in to your next generation, whether it would be your kids or grandkids.
Excellent. That's such great information. Thank you so much for teaching us not only the difference between RRSP and TFSA, but who needs what when.
Of course. And if you are watching this video and need help with budgeting, if you don't know whether you would do RRSP or TFSA, reach out to us at Always Bookkeeping and we'll be more than happy to help you.
Excellent. And how can they do that?
So you can visit us at www.alwaysbookkeeping.ca. Give us a call at 780-554-8356. One of our associates would be more than happy to give you a free consult. So the first half an hour, which is to learn more about you, your specific needs, what we can help you and create a customized plan for your situation. So those are the ways that you can contact us for a free initial consult.
Excellent. And so who should watch this video?
For any individual that need help with budgeting, retirement planning, individual that just need help on a monthly basis with the budgeting and then saving. Just reach out to us. We'll be more than happy to help you.
Excellent. Well, thank you so much for tuning in. If you found this video helpful, please hit the like button below. Send this off to your friends who need to hear how to retire safely and with some financial security. And if you have any questions, please drop them below and Tony will address them in a future video. Thank you so much for joining us. And thanks, Tony, for educating us.
Thank you so much for having me. And we'll see you in the next episode.